I have no idea how you found this show, but I'm glad that you did. Hey, I'm John Hicks. Join me and my band of crazies today on the Retirement Solution Podcast.
Here with John Hicks, I'm Jennifer Perry. Thanks so much for joining us this week. And if you want more information on John and the entire team at J. Hagan Capital, if you have a retirement question for us too, just reach out to us on the website at retirementsolutionradio.com. Speaking of websites, the IRS is having a big problem with this, John. I don't know if you've read about this, but I picked up this journal for accountants this week. I was looking to try to go to sleep.
What on earth were you doing this weekend where you picked up the journal for accountants? Oh, my gosh.
What
have weekends become
today.
these days?
I know this is really sad that this is where I'm at reading things these days. But I did find it interesting. They said the IRS right now is revamping its whole process for, listing those FAQs, the frequently asked questions on its website, because there have been so many different tax changes just in the last couple of years with the pandemic.
Sure.
There was the Secure Act before that. And now they're looking at another whole set of new changes depending on what Congress comes up with right now. So they're going to have to revamp their whole process because they were getting so many complaints from taxpayers and tax professionals who were looking for some easy answers on navigating some of the latest rules. They weren't able to keep up themselves on their own website. So, what does that say about how we're supposed to keep up right now?
I think that they halfway hope that we don't keep up with it so they can give us more penalties and more fines.
True.
No, but when you look at the tax code, guys, it's over 75,000 pages, 75,000 plus pages. And I'd have to go back and look. That may just be for individual tax returns. That may not even include business filings. So when you look at 70,000+ pages, how on earth are we supposed to know all that stuff?
Right.
I think it's impossible. And most of it, it's hiding in plain sight, in plain English. We just don't know where to look. So in our office, one of the things that we've really, really chosen to do is to not be experts on doing taxes. That's the most horrible thing I could ever think of in my life. Hey, no, that does not mean any disrespect to any accountants and bookkeepers and CPAs out there. We love you guys.
Yes.
You guys, I don't know how you do it.
Congratulations.
But you do.
Yeah.
But for us, what I do want to know, not how to file the returns, but I want to know what we're allowed to do, how we're allowed to do it, and what are those various strategies we can employ. Now, Jennifer, one of the things you just mentioned was, how do we keep up with it, all the changes? Well, in our office, that's one of the things that we really do. We subscribe to many different professional systems that help us understand and interpret the tax laws that benefit our clients the most. So our clients being those that are between 3 and 5 years of retirement or they're already retired. Now, everyone else, if they own C corporations, if they're all these things, we don't focus so much on that. Now, small business owners, we focus intensively on that because we want to know not really the actual letter of the law. We want to know what we're allowed to do and how we're allowed to do it. Now, over the past couple years, we've seen a dramatic amount of changes to what is happening with our retirement accounts in retirement, or if we're trying to unwind one of our businesses that we want to sell or things like that. So these strategies that you may have been using for years with your current portfolio, it may not work anymore, guys. We're seeing all kinds of proposed changes. They're going to potentially be coming through that might completely wipe out your tax plan. Now, how scary is that?
That is crazy scary.
That is unbelievably scary because there's a lot of people, and you guys know if you're out there, some of the reason that you structured, some of the reasons why you structured your portfolio the way you did is for tax reasons. You wanted to make sure, hey, it's good to make a little bit of money, but at the same time, I want to save that 25, 35, 40, 50% from the government. Well, if they take that away, guys, now potentially not only do we not have the tax break or not much of one, on top of that, we might be in a cruddy investment with the new tax structure. So, Jennifer, the big thing to understand here is that some of these new rules and some of these new proposals, that might make our tax plan obsolete. So imagine being in not only a plan that's not going to give us the most growth or safety in our portfolio, at the same time, now we don't even get the tax breaks. See, that's what I call a big old rip off right there, a rip off. So the one thing we have to understand is that if you are dealing with a financial advisor and they do not have an understanding of how to develop a proper tax plan, guys, that might be planning to fail when it comes to taxation. We have to stay up on this. If you don't do it, if you're not a CPA or a bookkeeper or accountant, or you don't spend hours and hours a month looking through this stuff, I suggest you seek out a fiduciary advisor who does this for a living, specifically with your needs. If you're 3 to 5 years to retirement, or you're already retired, you probably want to look for someone like us, who not only pay attention to this stuff, but we never want to let the tax angle destroy our actual portfolio performance. So we got to have a good mix of all of it.
Radio host, financial advisor, and now author.
That's right.
Check out John's book, The Retirement Solution, on Amazon.com, or get a free chapter now at retirementsolutionradio.com.
Say you're thinking of retiring maybe in your 50s or early 60s versus waiting until the age of 65. Morningstar's Christine Benz says, don't forget this huge expense.
You've got to figure out where you are going to go for health care. And if you're part of a married couple where your spouse is employed, this might be an easy answer where you can go on to your spouse's health care coverage. But if you do not have that luxury, you've got to figure out whether you're buying private insurance or going through the exchanges, and factor in that extra cost in terms of your in-retirement budget, because until you are eligible for Medicare, you will have that headwind of additional bills. And even when you are eligible for Medicare, you do need to bear in mind that you'll have additional healthcare expenses that Medicare doesn't cover.
This is also a huge chunk of change, isn't it, John?
Yeah, it really is. I know a couple years ago I saw a Fidelity study where they had estimated that the average 65-year-old couple, if they retired today, they would spend a roughly $300,000 to $360,000 in out-of-pocket healthcare costs over their retirement.
Wow.
So think about that, guys. This is after Medicare has paid their portion. This is the stuff that we have to pay out of pocket, $300,000 to $360,000. That is a huge amount of money. And in this case, that wasn't even including what if we retired early and we had to pay for that out-of-pocket healthcare cost until Medicare kicked in. So in our office, what we have typically seen, if someone wants to retire 3 or 4 years earlier than age 65, if they can't get on their spouse's plan or their spouse is already retired or didn't work, then typically the cost is somewhere around $900 to $1,200 a month. No, that's not the Cadillac plan. That's not the Cadillac plan. That's just basic cost for someone to be able to have health care. So if they had something dire that happened to them, they would make sure that they had coverage. Of course, there's still deductibles with that.
Yeah.
There's still, all kinds of out-of-pocket expenses you're going to have. So guys, you have to have that plan, how you're going to pay for that. So if we use the same example I used earlier, for every $1,000 a month of income that we're going to need, that would require an extra $240,000 of extra money in our portfolio to cover that $1,000 a month of cost.
One person, yeah.
Correct.
Wow.
So when you look at it like that, it can be fairly daunting. Now, having said that, there are all kinds of ways to maneuver a portfolio where we can earmark certain dollars for healthcare costs, where we can actually get insurance companies to give us a break on some of those costs, depending on the rest of our portfolio and how it's designed. So when we're looking through these costs, don't let healthcare costs be don't let it be like the fear factor on why you stay up at night. Again, that's one of those depends retirement strategies that we do not want to use. But the main thing is you have to know what part of your portfolio is earmarked for extra costs for healthcare, what part can be used to help offset and pay for healthcare between now and age 65, if that happens to be a case. It's not hard to figure out, but it does require math. I always suggest when it's going to be something that is this big of a deal, you seek out a quality fiduciary to help you with it, especially one that focuses on retirement, right? Because we want to make certain that not only do we get the math right, we get it right at the right time of our lives. So we want to focus on someone who only does this for their clients so that we know this might be our first retirement, but it might be their 1,000th of figuring it out. That would give us a lot more security when we're going through these numbers.
Like what you hear? Be sure to hit the subscribe button. And thanks for listening to The Retirement Solution with John Hicks.
The opinions expressed in this program are for general informational purposes only and not intended to provide specific advice or recommendations for any individual or any specific security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. J. Hagan Capital is a registered investment advisor. To find out if John Hicks is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal advice. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance products and annuities offered through John Hicks. Kentucky Insurance License Number 998827.